Hello everybody, this is Dave and thanks for tuning in as always. Today I thought it was well past time for me to check in with my second space investment, which is Planet Labs. Much smaller position for me than Rocket Lab, but I nevertheless do need to keep up with my research on that company, decide if I should be continuing to hold, buy more, or sell those shares. If you're familiar with Planet Labs, they are also trading down around all-time lows, but they're starting to look incredibly cheap on certain ratios and metrics. However, could that just be a value trap?
It's a trap!
Or is it really worth buying at these levels? That's what we'll be looking into today. Before we dive into that, I hope you'll consider hitting that subscribe button if you do find this kind of content useful. And if you've already subscribed, those likes and comments always help out as well. Oh, and by the way, I also need to thank Jeff Schmidt for joining the channel members. Very much appreciated, Jeff and everyone else who does support monthly. You guys really do help keep this channel going. All right, guys, let's dive into Planet Labs stock. So first of all, I'm sure the majority of you are already familiar with Planet Labs, but for those who are not, they are an Earth observation satellite company imaging the entire world every day, providing that data to their customers, both commercial and government, as well as trying to take advantage of AI in order to extract more valuable information from the changes the world is undergoing every day, and some interesting new products coming online like their carbon mapper, trying to track what areas are emitting the most greenhouse gases to make sure we can do something about that. So starting off with the stock, obviously it has not been a fun ride for Planet Lab investors, and that includes me. I think I bought I think it might have been in the threes, have to double check that. Yeah, down in the 1.7 range right now. Obviously not very happy about it. And yeah, I don't think there's any shareholder happy right now because we are pretty much at all-time lows. But let's talk first about why this could look super cheap at these levels. So if you're looking at pretty much any valuation metric when we're talking about ratios, there's a lot of reasons this thing looks cheap. Starting off with the price to sales, it's trading at currently 2.14, meaning that it is trading at a total market cap of just 2.14 times what they've earned in the past year. Price to book value, I'm going to dive into that a little bit deeper later on, but it is trading at less than 1, which is extremely unusual. Market cap, we're looking at under $500 million now for this company. It's sitting at 491. Interesting thing about this is if you do a little bit of math, back out what they have on the balance sheet in terms of total current assets, which is $370 million. This includes about $300 million in cash as well as some others, a few million more in net receivables and other current assets. That means if you subtract their market cap by just the cash in the bank and other current assets they have, and this is just not including non-current assets, which is a whole other category, but just current assets, the value the market is giving the whole rest of the company is only $121 million, which is not very much at all. So the market is valuing this not much more highly than the cash they have in the bank, literally, which is something that you cannot usually say about a growth company. But then, are they still a growth company? Let's keep looking. Going into the book value, I said I was going to talk a little bit more about this ratio. Their total liabilities currently sit at $183 million. Total assets, now this includes property and factories and, machines, basically anything that's worth money. We're talking $700 million. So if you subtract the liabilities from the assets, you're left with about $518 million. Company market cap, $491 million. If you're following along, very weird. That means the price of the company on the public markets is literally less than the value of the assets on their books. So theoretically, if the company went out of business pretty much right now and just packed it in, decided to sell all their assets, redistribute the money to their shareholders should come out a little bit ahead of where they're trading at currently. Obviously, they want to come out more ahead than that 0.5% discrepancy. but odd to see a company trading at a value less than, what they have on their books. This is very unusual compared to some other companies. I did want to just pull in a bit of a comparison. So Planet, as I said, price to book 0.9. Actually, I changed this calculation, was 0.98, but now it's 0.95. Rocket Lab looking at 3.13, which is obviously, over 3 times higher. Black Sky, a more direct competitor in the Earth imaging space, 1.87. Spire, also in the imaging space, but more on the SAR or radar side of things, all the way up at 3.44. So clearly, one item here is different than the others on the price to book. Now, on price to sales, they look a lot more reasonable, 2.22. in terms of the price to sales ratio, whereas Rocket Lab in a trailing 12-month metric is more like 7, Black Sky is 1.7, Spire 1.85. So interesting discrepancy, right? We have on the book value of their assets and the cash, very favorable looking ratio, but not so favorable when it comes to their revenue numbers. What does this tell you? Well, basically they have a lot of cash and assets, but the revenues are lagging a little bit compared to those competitors. So we have a lot of cash, potentially a lot of assets, and we want to see more revenues coming in from those assets. But the nice thing is that this does mean they have tons of cash on the balance sheet, don't have to worry about going out of business anytime soon, whereas some other companies like Aspire, like a Black Sky, have had much less cash available, and that has been a concern for them in the past. Now I want to take you all the way back to Planet Labs' SPAC presentation when they went public, what they told investors they thought they were going to do and what was going to happen. Compare that to what has actually happened lately. So they gave us a average compound annual growth rate of 44% that they thought they could achieve after going public. Looking at what has actually happened in this most recent year, going from 23 to 24 fiscal year, only 15% growth. So, 1/3 of a percentage basis of what they said they could promise. Not very good. Obviously, 15%, it's not nothing. They're still growing, but we really expected and were promised more revenue growth from the company, so that is a quite disappointing number. And the question we have is, where's the growth gone?
But why is the rum gone?
Looking at the growth rate, as I said, year over year, the previous year was quite good from fiscal 22 to 23. We had 45% year over year growth. So end of 2022, everyone in the Planet Lab shareholder community, if you can say there is such a thing, was really celebrating them delivering on doing what they said they would do and being one of the few SPACs that actually delivered on their promises. Unfortunately, that has absolutely collapsed in fiscal 24, and the stock has suffered for it. So not only is the growth not as good as we expected, but it's really called into question my confidence in this whole management team. And I think a lot of other investors feel the same way when management is not able to deliver on what they expected and promised. Looking at adjusted EBITDA, once again, comparing what they said they thought would happen versus what has actually happened. So in fiscal year 24, they did expect just $10 million in negative adjusted EBITDA, practically break even. Obviously, we can see in the adjusted EBITDA chart from the most recent earnings call, that's Q4 fiscal 24, it did not happen. They burned 19 million, then 14, then 12, then 10. Nice thing is this is headed in the right direction, and if things continue, we will be looking at adjusted EBITDA break even, perhaps even by the end of the year, which is what the company has been guiding. Sad thing is they're doing this by making internal cuts, so obviously you feel for anyone who's lost their job and cost-cutting measures with the company as opposed to what they originally expected, which is just, insane growth with that 44% compound annual growth rate. They had originally projected a positive 67 million EBITDA number for fiscal 25 and 187 for fiscal 26. I do not expect those to happen at all, but I will be happy with a break even if they do achieve that. So if you combine civil government with defense and intelligence into an overall government slice of the pie, I have been pretty okay with how that has grown, but what's really kind of disappointed me is the commercial customer base. Just seems like it hasn't been there, hasn't grown as much as I was hoping and as a lot of us were hoping. The government is obviously a very good customer to have. They always pay their bills on time and they can be relied upon. But the other side of things is if you're changing the thesis around the company to be majority relying on only governments going forward, that's a bit of a new ball game compared to what we were thinking about just a few years ago, and a lower overall total addressable market. So that's something to keep in mind. I would really love to see the commercial side of the business pick up over the coming years. Looking at how they've fared versus some competitors, so you can't even blame the overall market conditions here for Planet Labs, because we have two other companies playing in the same Earth observation space, Black Sky and Spire, that I mentioned previously. Planet Labs significantly underperformed them both over the past year, looking at down 50+%, whereas Black Sky is about break even, just 1% below break even, and Spire having an absolutely amazing year, up 81%. So congratulations to Spire. Rough time for Planet Labs shareholders, and it goes to show you can't blame the overall markets and interest rates if a company like Spire is actually doing well in this environment. Taking a look at backlog and talking about how management thinks they're going to recognize that backlog going forward, they did have at year end $242 million in backlog. And they also said here that over the next 12 months, they expect to recognize about 67% of that backlog. So if you do a little bit math, you're looking at $162 million being recognized from that backlog in this coming fiscal year. Obviously, the previous fiscal year, they made $220 million. 162 being a lot lower than 220 means if they're going to make up for that shortfall and deliver at least 10 to 15% growth this year, they're going to need to book a lot of new customers and actually get the revenues flowing from them in this year, as opposed to booking customers that are only going to hit the balance sheet in future years, which seems like a little bit of a tall order, and I'm not going to lie, it has me a little bit concerned. Contrast that with a company like Rocket Lab, where they say, okay, we're going to recognize something like 60 or whatever percent of our backlog. You do the math, that's already growth over their previous year and makes you feel much more comfortable with their situation. So while on a lot of metrics Planet is cheaper, a growth company that is no longer growing is a recipe for disaster. And this is something that you have to keep in mind, not always just chasing the valuation metrics when it comes to price to sales, price to books, and all that kind of thing. A few quotes from the earnings call here that they said in reference to guidance. They are expecting $58 to $61 million in Q1 of this year, which does represent 10 to 16% year-over-year growth, which is good because I feel like we need 10 to 15% growth going forward as like a bare minimum for this stock. If it drops to no growth and flat, that's just devastating. You're investing in a not profitable company that's not growing. That is not where you want to be. So yeah, bare minimum, I think we really need to see 10 to 16% growth continue for the year, unless they really prove to us that maybe this is a one-time year, there's weird stuff going on, and the growth is really going to pick up again next year. They expect their adjusted EBITDA number to be -11 to -9 million in the quarter, which is pretty flat quarter over quarter as well, depending on where it falls in that range. We did see a -$10 million number last quarter. The CFO did also say that I'd like to emphasize our commitment to reaching our target of adjusted EBITDA profitability by the fourth quarter of this fiscal year. As Will mentioned, we are prioritizing investment behind core areas to capture the market opportunity unfolding in front of us. In parallel, we will reduce expenses where necessary to deliver on adjusted EBITDA profitability. So once again, looking like that drive to adjusted EBITDA profitability, a lot of it coming from internal cuts and reducing their investment in the future, which can be a bit of a double-edged sword. Let's go ahead and have a quick discussion, wrapping up all this information along with some final thoughts. So what we saw when we did our review of Planet Labs is a company that on the face of it has an excellent balance sheet with a lot of cash on hand. They have a long runway before they have to worry about going out of business, as well as a good amount of assets on their balance sheet. And from that point of view, they look incredibly cheap. However, the growth is stalling, and this brings up several huge question marks around the company and is the main reason why the stock has absolutely collapsed. I don't think it's fair to blame all that growth stalling on the overall markets, as we've seen some other players in that Earth observation space continue to grow pretty well. Ultimately, if Planet can grow at least 15% going forward, I think they should be fine. If we see the growth completely stall, we're looking at big trouble. If they can return to 40+% annual revenue growth rates, the stock will look like an absolute steal, and anyone who buys at these levels will look like a genius. The question we need to answer is, will that growth come back? It's an extremely difficult question. I don't have all the answers for you. I do think that, they're always talking about their order pipeline and they're in discussions with so many customers, which is nice, but ultimately it's not real until you sign on the dotted line. So I don't put too much stock in that. The growth on the commercial side of things hasn't really been there as much as I would like. Still been okay on the government side of things. What we might have to worry about is a bit of a shift to the right, and Scott talked about this in his previous video as well, and it just made a lot of sense to me. So if you haven't checked out Scotto's videos, I do recommend his channel. There's a lot of elections coming up, whether it's where I am in Canada, whether it's the United States and other countries around the world. Seems like a lot of people are starting to move further to the right of the political spectrum, which is usually less focused on the environmental side of things. Whether you agree with that or disagree with that, that's beyond the scope of this video. But it is possible that the efforts of governments, when you're looking at conservation, when you're looking at tracking carbon outputs around the world to fight climate change, could face some cuts in the coming years. If you see someone like Trump back in the White House, or various European countries seem to be moving to the right, or even in Canada, if you do have the Conservatives retake power, as does look incredibly likely. Whether that affects Planet Labs' outlook for future growth, I think it will, at least somewhat, and the question is, how much can the commercial side of things pick up that slack? They do have uses beyond the climate change side of things. I just want to emphasize that, tracking wildfires, tracking, geopolitical issues, imaging the entire world every day certainly came in handy with the Ukraine situation, as well as many other situations around the world. Don't want to completely count them out. It'll just be an interesting time for them, and we don't have much guidance anymore. They kept missing guidance, so now they're only going to be guiding one quarter out instead of really trying to guide further out, because the growth seems to be so uncertain for the company. So I have a ton of questions around the growth. If it comes back, it'll be an absolute steal. I just don't know. I don't think I want to sell at this point, but I do have to say my confidence in the company's management has been a little bit shaken, whereas confidence in Rocket Lab's management, for instance, remains very strong for me. What I can tell you is I'm going to be tracking the earnings growth very closely. I'm going to be watching out for any new contracts they sign, anything else we can glean from management interviews. And if it looks like there's a sign that growth is turning around, this might be one to jump on. If not, well, you better buckle up, because it's going to be a rough ride. Let me know how you're thinking about this stock down in the comments below. Always appreciate the insight I do get from the viewers and channel members. And thank you so much for those channel members, by the way, for continuing to support these videos. If you did enjoy this video and got some value out of it, please do consider hitting that subscribe button to help continue supporting the channel. I very much appreciate every single subscriber. Hope you guys have a great day and a great rest of the week. I will see you in the next video. Bye for now.